feel like I have a bit of an odd task this afternoon. I have to introduce people who need no introduction. All right. All right, great. Thank you. Our next speaker is Professor Andrew Lowe. Andrew is the Charles E. and Susan T. Harris Professor, Professor of Finance and the Director of the Laboratory of Financial Engineering at MIT Sloan School. Andrew's had many awards, and his resume is really longer than Yao Ming is tall. His awards include the Alfred P. Sloan Foundation Fellowship, the Paul A. Samuelson Award, the American Association for Individual Investors Award, the Graham and Dodd Award, the 2001 IAFE SunGard Financial Engineer of the Year Award, a Guggenheim Fellowship, the CFA's Institute for James R. Burton Award, and awards for teaching excellence from both the Wharton School of the University of Pennsylvania and MIT Sloan. As you can see, Andrew's really not leaving many awards for the rest of us out there. Andrew's written, as I mentioned earlier, he has a far-ranging research interests. One of my favorite of his papers, which I read this fall after reading Jerry Coyne's Why Evolution is True and a book on the inner fish in us. Andrew has a paper called The Origin of Behavior. If you haven't seen it, it's worth reading. You just have to love any finance professor whose research helps explain the behavior of ants. I know in my own apartment, there's only 2 human beings that really need to explain behavior, but there could well be thousands or tens of thousands of ants whose behavior needs explaining. So it's been somewhat beneficial for me. Anyway, so glad to be able to introduce Andrew.
So I want to thank David for that very generous introduction. And concur with his assessment about the need for explaining behavior, particularly in New York City apartments. I grew up in New York, and in my day, it was really cockroaches that was the problem, not ants. I also want to start by thanking all of the folks who made this event possible, particularly Dean Schmidtlein, who's provided enormous support for the finance group over the last several years. The finance group is bigger than it's ever been in the history of the group. And that's really due largely to Dean Schmidtlein's support for what we've been doing. I also want to thank the Office of External Relations, particularly Chris Schaefer, Donna Russell, for making this event really just easy for us to participate in. And also Kelly Nixon and Patsy Thompson for helping out with the organization and setting this up on the finance side. And then finally, I want to thank all of you for coming to this phenomenal gathering. I've done many talks of this type over the years, and I have to tell you that the alumni events are always my favorite because the amount of energy in this room is really palpable. And I've actually participated in alumni events at different universities, and I can tell you that there's a very, very big difference between MIT alum and others. I don't know quite why that is, but it's really there. You know, people used to say that MIT grads are all nerds. And I've now heard an assessment of that. What do you call a nerd in 10 years? And the answer is boss. So congratulations to all of you for changing that perception. So the topic of my talk today, the title is actually something that I happened to overhear several years ago when I was teaching an investments class. I had just gone over the efficient markets hypothesis, and I was walking down the hall, and I noticed that a couple of students from my class were talking to each other in a rather animated fashion about what we had gone over. And I was very gratified by that my lecture inspired such interesting dialogue among the students. And then a third student came by who wasn't in the class, and asked, what are you guys talking about? And I overheard one of the students say, oh, we're just talking about lies that my finance professor told us today. And it was a little discouraging. But I suspect that all of you may share in some of that sentiment. So let me start by asking a question. How many of you are familiar with the efficient markets hypothesis? Yeah, pretty much everybody. OK. How many of you actually believe the efficient markets hypothesis? That's kind of discouraging, don't you think? Because the efficient markets hypothesis is at the center of what we teach in all of our finance classes. I still teach it in my 15401 class. When I started taking finance as a graduate student, the reason I got interested in finance was because I took Bob Merton's 15415 in the fall of 1977 and 1980. And it was amazing to me that you could actually come up with a theory that explained everything, which in those days, that's exactly how we looked upon the efficient markets hypothesis. And now, most of you don't believe it, yet it is the bedrock of what we teach in finance. I mean, that seems to be a bit of a problem, I would say. And so over the years, I've tried to grapple with this inconsistency, the fact that most of us, even those of us in academics who teach it, we have misgivings about it. And what I want to do today is to provide you with a very quick overview of some of the research that I and my co-authors have been doing on trying to reconcile the efficient markets hypothesis with human behavior. That's obviously the main criticism. It's the fact that people don't behave the way that we model them to behave. So what I'm going to do in this very short time is to give you a couple of examples and provide you with a different narrative for how to think about financial markets from a broader perspective, and why it is that actually you should still believe in the efficient markets hypothesis while acknowledging there are some exceptions and deviations that are important in their own right. So first of all, let me start by saying a word of congratulations to this year's Nobel Prize winners, Gene Fama, Lars Hansen, and Bob Shiller. And a number of my colleagues, have been a bit embarrassed about the fact that these three won the Nobel Prize in the same year, particularly Shiller and Fama. In fact, one of the reporters who called to talk to me about this said that, isn't this a clear indication that finance is not really a science? Because only in finance could you have two Nobel Prize winners actually win for saying the opposite things. And it's true. It's true. But actually, I think that the choices were inspired because it actually brings a narrative to the table that really isn't right there, and we're not comfortable with it. And the narrative is that markets are efficient, according to Gene Fama, except when they're not, according to Bob Shiller, and quantitative tools can help us tell the difference. That's how I interpret it. It's the wisdom of crowds versus the madness of mobs, and then, of course, the power of quants. That's the ultimate. Now, I want to be a little bit more descriptive than that and argue that efficient markets hypothesis is part of a traditional investment framework that is broken. The traditional investment framework is not wrong, but it's simply incomplete. And it has to do with the fact that most of us economists, we suffer from the psychological disorder that I call physics envy. We would love to have 3 laws that explain 99% of all behavior. And in fact, we have 99 laws that explain maybe 3% of behavior, and it's terribly frustrating. And so behavior really has to do with how the environment causes us to react. When the environment is stable, you're going to get stable investment policies. So 60-40 makes perfect sense if the volatility of markets and the expected return of markets are roughly the same over a period of time. But when the environment is unstable, as it has been for the last decade or so, you're going to get very, very different kinds of policies being more effective, more dynamic policies. And I'll try to describe a few of those a little bit. So I want to show you that the current environment that we're living in is highly dynamic, and as a result, the traditional investment framework looks like it's failed badly, when in fact it really hasn't failed. It's just simply temporarily on vacation, and we need to think about how it is that these dynamics change over time and market conditions. So I'm going to put forward a different model, a different interpretation, something that I call the adaptive markets hypothesis. And I'm hoping that in this 30 minutes, I'm going to be able to at least pique your interest so that you'll take a look at some of the work that my co-authors and I have been doing. So let me first start with a very short version of the adaptive markets hypothesis. What is it? It's pretty simple. It basically starts with the viewpoint that individuals act in their own self-interest. Now, I don't think any economist would argue with that. But starting with points 2 through 5, I think we depart from traditional economics. Individuals, they don't optimize. They satisfice, a term that Herbert Simon coined many decades ago. They really use heuristics, rules of thumb, and they make mistakes, and they learn from the mistakes, and they change their heuristics over time. As a result, they learn and adapt, and ultimately, it's competition that drives adaptation and innovation, and it's these evolutionary dynamics that actually explain how markets behave, how markets work over time. So at this level, this seems sort of amorphous and vague, and I'm going to try to put some concrete terms to this over the course of a few examples. Let me first start with this notion of risk. We all have a very clear idea, I think, of what risk is. Certainly in finance, we measure risk as standard deviation, and we assume that people have mean variance preferences. They like mean, they don't like variance. And so out of that framework has come enormous amounts of insight and financial products. I want to illustrate to you an aspect of human behavior that our models really don't take into account, and that's adaptation. So I'm going to do this by way of a particular piece of research that was done quite a few years ago, in 1975, by an economist at the University of Chicago by the name of Sam Peltzman. Now, he published a blockbuster paper in 1975 in the Journal of Political Economy, and it has a rather boring title to it. The title, whoops, let me skip this. The title is The Effects of Automobile Safety Regulation. And you might not think much of this, but it launched hundreds of other studies and a huge debate, both in academia as well as in policy circles in government. What Peltzman was trying to do was to understand how it is that humans react to various kinds of regulation, in particular, safety regulation. In the 1960s and 70s, automobiles weren't nearly as safe as they are today. And so little by little, we developed various different safety devices, reinforced bumpers, collapsible steering columns, seat belts, eventually airbags, and crumple zones. And so Peltzman decided to ask the following question. Given that these safety regulations were quite expensive, they caused companies to have to spend a lot of extra money in order to install these devices, wouldn't it be useful to find out how effective they were? How many lives did they save every year after you made these safety devices mandatory? And so he decided to measure it. He took a look at all of the different safety features that were mandated by law, and he simply tabulated the number of highway deaths from traffic accidents before the law and after the law, just to see how well they worked. And what he found was something absolutely astonishing. He found that there was no effect at all. No lives were saved. Now that's not exactly true. After these laws were enacted, and after these safety features were installed, the number of highway deaths actually did go down temporarily. And after a couple of years, it went right back up. And this happened actually time and time again. It was not just with one of these safety devices, but with all of them, except in one occasion, there was a permanent decrease in the number of deaths of automobile occupants. But it turns out that in that case, the number of pedestrian deaths actually increased by approximately the same amount, offsetting the gains. And so his interpretation of the data were that once you make cars safer, people, they realize this, and they will adapt, and they will drive more recklessly. And as a result, the safety benefits really don't exist. Now, you can imagine why this is so controversial. So a number of critics said, well, wait a minute, you didn't control for a whole bunch of effects. For example, you didn't control for driverability, or you didn't control for the particular setting. Were they driving to work, or are they on vacation? Was this urban roads, or was this in the city or in the country? And so it launched a whole bunch of other studies. And in some of those studies, they confirmed the so-called Peltzman effect. And in other studies, they contradicted it. And it wasn't until one study that controlled for all of these effects was finally published that there was some conclusive evidence that the Peltzman effect was in fact true. And that study basically eliminated all of these other considerations, and the only objective of the drivers in the particular study was to get to their destination a little bit sooner. And so it was clear that because that was their objective, that really the effect of an increased or a decrease and then an increase again in the number of deaths was in fact due to driver adaptation. Anybody guess what that context might be, where the only thing that matters is getting to your destination a little bit sooner? Doesn't matter, income, education, driver ability, all of those things are roughly comparable and controlled for. Pregnant spouse getting to the hospital, that's good, except it's hard to collect data on that. What's that? Airports, getting to the airports? Maybe, although you could be getting there to catch a flight, or you can be getting there to pick up a passenger. So there would still be a little bit of controversy about whether you properly controlled for that. Going to a bar after work? Now we know what you like to do, but no, because again, there could be many reasons why you might do that, and it depends on where the bar is and what you're going to be drinking, or are you the designated driver? Well, let me just tell you, because it's a beautiful example of economics at play. The setting is NASCAR. In a NASCAR race, the only thing that matters is getting across the finish line a little bit sooner, right? Well, these two economists, Sobel and Nesbitt, they actually looked at NASCAR races and the accident rates before and after safety features were installed. And what they found was remarkable. They found the Peltzman effect on steroids. What happens in NASCAR, and this is a problem that the NASCAR organizers are well aware of and they're really concerned about. Every time you install a safety feature in a NASCAR car, the number of deaths actually increases. It doesn't stay the same. It goes up. You put titanium reinforced struts on a NASCAR car and you tell a race car driver that you've done that, he'll say, fantastic, I'll take advantage of that. And so this effect is real. In fact, Peltzman argued that if you want drivers to drive more safely, get rid of the safety features. You should install metal spikes pointing at them on the dashboard. That will get them to drive more safely. And so the point is that we humans, we're smart. We can read, we can learn, we can observe. And when we know that our car is safer, we will drive a little bit faster, a little bit more recklessly. We'll push the envelope just a little bit more because we're willing to take a certain level of risk. When you tell us the risk has gone down, but the expected return is the same, well, if we increase the risk to where we were comfortable, we should increase the expected return. All of these safety features in financial jargon, what they've done is to increase the Sharpe ratio. And if you increase the Sharpe ratio, and I'm willing to take a certain amount of leverage, I will lever up. The problem is if our perception of risk differs from the reality of risk, then we're levering up in situations where maybe the risk hasn't changed, it's just that it feels like that to us. Maybe the risk of highway accidents are the same, but we just feel safer because we're driving a tank. And so we are going to drive more recklessly. So let me talk about implications for finance. I'm going to go over just two of these implications of adaptation. You're welcome to read our papers that describe in more detail, first of all, the mathematical framework. I'm going to leave out all the math. I realize that I'm being less than rigorous, but I'm often reminded by my colleagues that along with rigor usually goes mortis. So I'm gonna keep the rigor to a minimum. So let me start with the implications for finance and give you a new narrative of what's going on. First of all, I want to argue that 2008 was a watershed year for the financial system. Sorry about that. A few years ago, I read a book on how to make PowerPoint more effective, so I try to practice on you. So. What happened in 2008 was that we discovered that the traditional investment framework was broken. Three tenets of modern finance: the long-only approach to investing, diversification across stocks and bonds, and asset allocation as a way to control risk, 60-40 versus 70-30. Those three principles were badly shaken in that year, because in that year, everybody lost money except investors in government bond funds, whether you were large cap value, small cap growth, international, balanced, whatever, everybody lost money. And even though you thought you were diversified, everything moved together. And whether you were 60-40 or 70-30, you got hit with way more losses than you ever expected, given your risk profile. And so this traditional investment framework, I want to try to unpack it and try to understand what went wrong. Now, by the traditional framework, let me tell you what I mean. It's a bit like a creation myth that we tell our finance students. And the creation myth goes a bit like this. In the beginning, and by the beginning I mean 1964, in the beginning, Bill Sharp said in 1964, let there be beta, and there was beta, and it was good. Out of this framework came the notion that diversification matters, that you have to worry about correlation, and that benchmarks, performance attribution, and all of the various products that emerged from this factor model came about. Probably the most important achievement in all of this, and this is not a trivial achievement, is that it gave us a method for discharging our fiduciary duties as portfolio managers, as financial advisors, as pension plan sponsors. Really important. And there are lots of products, not the least of which are index funds, passive investing, that grew out of this multi-trillion-dollar industry out of this one idea. Now, this framework requires several assumptions. Things like linearity, stationarity, rationality, and most important of all, market efficiency. What if some of these assumptions don't hold? In fact, I could argue that none of these assumptions holds. Every single one of them can be challenged. Now, to be fair, economics is very different from physics in the sense that I tell my first-year students that the premise that you should all go into economics with is that all economic theories are wrong. You don't have to worry about testing one or the other. We know that they're all wrong. The question is not whether they're true or false. The question is, how wrong are they? In other words, how good an approximation are they to a much more complex reality that is hopelessly complicated and impossible for us to try to model precisely? How good an approximation is it? And I would argue that the capital asset pricing model, efficient markets, the whole rational expectations framework of economics has been a remarkably good approximation for a very long time. And I'll illustrate that by this graph. Most of you have seen this graph, even though you don't know it. It probably doesn't look familiar to you. It's the graph of the cumulative returns of the S&P 500 from January 1926 to September of last year. And the reason it doesn't look familiar to you is because I've graphed it on logarithmic scale. If I graphed it on a regular scale, it would look like that prototypical hockey stick, right? On a logarithmic scale, vertical distances all amount to the same rate of return. And so this graph illustrates something really remarkable about US equities. What it illustrates is that for a period of about 7 decades, US equities have been a remarkably consistent way of earning an expected rate of return. And you know all this because many of you are in the finance field, so you know that equity risk premium of 8.3%, volatility of 15%, that's really reliable over a very long period of time. And during that period of time, I'll argue that the assumptions that we use for efficient markets, the capital asset pricing model, modern investment theory, has been a remarkably good approximation to a much more complicated reality. You can understand now why Sharp, Markowitz, and all of the others developed their theories in this kind of an environment. Because using historical data from the 1930s to the early 2000s, it doesn't matter which 10 or 20-year period you pick, you're going to get roughly 10% return on your equities and roughly 15 to 20% volatility. That's a pretty good, reliable method for building your retirement wealth. The question that you need to ask yourself is that over the last decade, does that set of assumptions still work just as well? Have the last 10 years been just a temporary blip in an otherwise straight line that continues off? Or has something changed? And what I want to argue is that something's changed. Now, we're not the only market for which something has changed. If you look at Japan, the Nikkei 225, you've got that same steady growth period for a period of time, and then it just goes sideways. That sideways period has lasted over 2 decades now. And so I would argue that something has changed there. What's changed, I think, is that there's now a much more complicated dynamic between the wisdom of crowds and the madness of mobs. We understand the wisdom of crowds from James Surowiecki's book by the same name, that when you have lots of people making decisions, individually, their decision may not be so rational, but when you put them all together, they can come up with some remarkably rational insights. The jelly bean jar experiment is a classic case in point. I would love to do that experiment if we had more time. If we're trying to guess the number of beans in that jelly bean jar, any one of you would probably be pretty far off in your estimate. But if I got all of you to take your estimates, put them together and average them, my guess is that the result would be remarkably accurate, within 5 or 6 beans of the actual number there. How does that happen? Well, according to Surowiecki, you need 2 things for the wisdom of crowds. One, you need a crowd. You need a lot of people. But more importantly, you need an independent crowd, meaning that every one of you has to be thinking independently of everybody else, so that when all of you pool the information together, the errors will cancel out. We have a term for that in finance. It's called idiosyncratic risk. When you pool all of the various different components of your estimates, idiosyncratic risk gets averaged out. What's left is the truth, and the truth gets uncovered. If, on the other hand, all of you are using the same method for doing the estimation, and that estimation is false, then that falsity is going to be reflected in that average. The law of large numbers doesn't work if we don't have independence in the crowd. And the lack of independence, we have a name for that too. That's called systematic risk. Sharpe came up with these ideas decades ago, having no idea that they actually had far-reaching implications from an evolutionary perspective, not from a mathematical perspective. And a classic case in point is the upper right, an elephant stampede. I don't know how many of you have ever experienced an elephant stampede. I haven't, but I heard of somebody who did. He was a hedge fund manager who actually went elephant hunting. As politically incorrect as that is, hedge fund managers will do what they do. And so he decided that he had to have an elephant's head on his wall. So he hired a tour guide and had completely outfitted his safari to go after elephants, and came upon a herd of elephants. At which point he stood up in his Range Rover and took aim. And before he pulled the trigger, apparently one of the tour guides, made a noise of some sort. All of the elephants turned around, saw his party, and started charging right at them. And he wrote later that he had never seen a creature that large move that quickly and cover such a long distance. They were probably a half a mile away. And literally within a matter of seconds, this elephant stampede was upon them. The Range Rover was trampled. It was bounced around like a toy car, and an elephant ultimately trampled on it. The driver was killed instantly. And this hedge fund manager ultimately broke 80 bones in his body and was in traction for 14 months. And to this day, walks with a limp and still has chronic pain. And he said he never experience such a force of nature as seeing that herd of elephants move as quickly. They flatten the entire field of trees and anything in its way. That's the power of the madness of mobs. And below that, you see a different kind of a mob, a bank run at Indy Mac. When we all start thinking alike, when there's systematic risk, the force of nature takes over, and you don't get the wisdom of crowds. So I want to talk about two specific implications of this. The first is the fact that alpha turns to beta as through this kind of adaptive process. Now, what I mean by alpha is unique investment acumen. Individuals who are able to pick stocks or identify distressed opportunities can generate expected returns higher than the risk-adjusted rate. And so I want to give you an example of that. How many people have heard of John Paulson? Paulson and Company? Yeah, he's the famed hedge fund manager that in the mid-2000s bet against US residential real estate and did it in large size through his hedge fund and ultimately made tens of billions of dollars for his investors and billions of dollars for himself. Well, in 2009, his right-hand man, Paolo Pellegrini, decides to leave Paulson and Company to start his own hedge fund. Now, at the time, Paulson was the only hedge fund manager that was really betting against real estate in size. There was another couple of smaller hedge funds, but the one big name in the field was Paulson. And for a couple of years, he was sort of out there proselytizing, trying to argue with people that residential real estate was way too high. It was a bubble ready to burst. And it took him a while, but he ultimately succeeded and won. So at that time, I would argue that Paulson had unique alpha. Paolo Pellegrini was the individual that helped Paulson increase his bets by using derivatives and the CDX contracts. And in January of 2009, Pellegrini decides to leave Paulson. Now, I don't know anything about the situation. I don't know Pellegrini or Paulson, but there's a great book that was written by the Wall Street Journal reporter Greg Zuckerman that describes the events. And my assumption is that at the end of 2008, Paulson was paid a huge amount. I think his take-home pay that year was $1.5 billion for the bets that he made. I don't know if I'd like to see what his W-2 looked like. It was kind of impressive. But my inference is that Pellegrini was probably paid only a ridiculous amount in his bonus as opposed to an obscene amount. And so he decided that he was going to leave, start up his own firm, and be able to make that obscene amount himself. And so he did. He left and started up his own fund. And within a matter of weeks, he had raised $1 billion, which is not an easy thing to do. I mean, back in 2009, $1 billion actually meant something, not like today. And so you might think that maybe investors took money out of Paulson and gave it to Pellegrini. That's not what happened. The investors were delighted with Paulson. They kept the money with Paulson. They gave more money to Pellegrini. And why is this important? Because this is an example of alpha starting to degrade, to become beta. Because when there was only one, now there's two. And then there's 4, and then there's 8. And pretty soon, you get lots and lots of people doing the same kinds of things. Other examples include, well, value, growth, momentum, earning surprise, mortgage-backed securities, equity market neutral, merger arbitrage. Virtually every successful type of hedge fund strategy has now become a crowded space. And if many people are doing it, if it becomes so commoditized that there's now an ETF for it, as there is for the carry trade, as Adrian has told me, then you know that the expected returns that are being earned is not pure alpha, but very likely beta, what Bill Sharp called systematic risk. Except now we're not just talking about market beta, we're talking about currency beta, commodity beta, credit beta, liquidity beta, all sorts of systematic risks. Now, here's the most technical slide I have of how this mechanism works. You start with alpha that's unique, then eventually it gets copied, and now it's still novel but different colors of alpha, but still related. And then after a while, it gets popular, and finally, it eventually gets commoditized, and either it's completely arbitraged away, or if there's any expected return left, it's beta. I want you to see that that beta is made up of little tiny alphas. It took me a long time to line that up, so you should really appreciate that. Yes, thank you. Okay. Let me, since I'm running out of time, let me give you my second implication and then conclude. I want to have plenty of time for Q&A. The second implication is that the risk-reward trade-off that we all talk about, there's a trade-off between risk and expected return. Higher risk, higher expected return. Investors have to be paid for taking risk. We teach that to our students ad nauseum throughout the entire semester of 401. And the evidence is plain. When you take a look at the Ibbotson data, higher risk assets earn, on average, higher expected rates of return. The risk-reward relationship absolutely seems to apply across various different kinds of assets. Large cap stocks earn less than small cap stocks, and small cap stocks earn more than treasury bills. It's a very, very reliable relationship. However, this doesn't take into account the madness of mobs. And by the madness of mobs, I mean when there's a flight to quality, a flight to safety, investors are, in a technical sense, freaking out. They take their assets from the high-risk securities, sell them, and put them in low-risk securities. And the kind of freak out that I'm talking about is, well, things that all of us are familiar with. From the period 2008 fourth quarter to 2009 first quarter, if you ask what the maximum drawdown is, the maximum to peak to trough decline, you're getting a roller coaster ride of about minus 51%. Minus 51% maximum drawdown for the S&P 500, something that all of us have in our portfolios. And this is not such a rare event. You know, it's one of these once in a 100-year events that happens, every 5 years. And just a few years before, you have another 40.7% roller coaster ride. What are the implications of that? Well, let's calculate what the volatility and expected returns are over not 100-year periods, but how about 5-year periods? This is a graph that plots in red the volatility of 1,250-day or 5-year rolling window volatility estimates in red, and in blue, the compound rate of return over that same window using rolling windows, okay? What you observe here is exactly the opposite of what we teach our students. The period of high volatility in the 1930s, that was a period of low expected return. Volatility goes down, expected return goes up. When expected returns go down, volatility goes up. It's exactly the opposite of the risk-reward relationship. Now, this is not new to me. This was first pointed out by none other than Fisher Black. In 1972, Fisher Black noticed that, whenever stock prices fall, the volatility of those stocks go up. And ultimately, he called this a leverage effect, because if you've got debt in your capital structure and the stock price goes down, you're a more highly leveraged company. And that increase in leverage ought to boost the volatility of your equity rate of return, right? That sounds good, except that in a paper that I completed a couple of years ago with a student of mine, Yasmina Hasan-Hadjic, we actually looked at a subsample of companies that have never had any debt in their capital structure. And in companies that are all equity financed, this effect is even stronger. In fact, this effect you can see in Eurodollar futures. You can see this in pork bellies. You can see this in lots of risky assets where there isn't any obvious analog of leverage. When volatility goes up, expected returns go down. And our interpretation is that this is a behavioral phenomenon. It's the freak-out factor. When the volatility goes up, people say, gee, that's a lot more risk than I bargained for. I'm going to get rid of some of my risk. And that pulls money out of that asset, and it depresses its expected return. So there's a new investment paradigm that I think is emerging from these considerations. All of the efficient markets implications, they're not wrong. They're just incomplete in that they don't take into account the madness of mobs. And when you do, you actually see some very, very different implications for efficient markets. The adaptive markets hypothesis actually illustrates, I think, a more practical approach to thinking about investments. It doesn't discard efficient markets because during normal times, that is the way the world works. But markets aren't always normal. So I'm reminded in concluding that it takes a theory to beat a theory. That's why I came up with the name adaptive markets, for lack of a better term. And by the way, you won't find this in any textbook. In fact, I think the only reference to it is by me. So it's still very much a work in progress. But the basic idea is really the parable of the 5 monks who, blind from birth, encounter an elephant for the first time. And the monk that grabs the elephant's trunk, he says, gee, an elephant, it's just like a snake. The monk that grabs the elephant's leg says, you know, an elephant, no, it's more like a tree. They're not wrong, but they don't have the complete picture. And neither behavioral finance nor efficient markets has the complete picture. But understanding how they adapt during various kind of market conditions, that will give you the complete picture. Human behavior has been pretty much the same for the last 60,000 years, but our environment is dramatically different. And it's really that conflict between the adaptive nature of our behavior and the complex environment that we're in that really has given us where we are today. Adam Smith has less to do with financial markets, in my opinion, than this fellow, Charles Darwin. And ultimately, it's about how adaptive you are. All of these ideas were actually brought home to me quite personally years ago when my younger son was turning 5 years old. My older son was 10 at the time. And during the day, the older one, jealous of his younger brother's attention, was trying to rain on his parade, telling him, Wesley, today you're 5, but I'm 10. That means that I'm twice as old as you, I'm twice as tall as you, I'm twice as smart as you. Basically, I'm just twice as good as you. And that really frustrated his younger brother until dinner time when he actually figured out a response. He turned to his older brother and he says, Derek, you're twice as old as me, right? His brother says, yes, that's right. He says, that means you're going to die first. If you understand that, then you understand adaptive markets. Thank you. I think we have time for a few questions. Yes, can you wait for the microphone, please?
Just out of intellectual curiosity and some research we did, we plotted all mutual funds available in the US, index as well as managed, and equities on a simple graph. Risk on the x-axis, return on the y-axis. And we thought that we might see at least a whole bunch of funds along the so-called efficient frontier. Now, what we find for all different time periods we try this experiment, all these portfolios, they appear to be below the frontier, and they're like a huge cloud. And for example, you pointed out 2008, we found exactly what you're pointing out, that as the risk increased, the returns fell.
Right.
Very clearly, the whole cloud.
Yeah.
But why is it that in general, when brokers tell people, hey, you want to get higher returns, you got to be willing to take higher risk. What we find with this class of portfolios like mutual funds and ETFs, that it doesn't seem to hold. Why is it so, please?
Yeah, well, so first of all, with regard to brokers, you know why they call them brokers, right? Because all they do is they make you broker and broker. I shouldn't say that. I have many friends in the brokerage community. But to answer your question, I don't know why. I can't tell you an answer why that is all the time. I think it's very much data dependent, context dependent. My conjecture of why it might be the case is that if you look at various different samples of data over various different time periods, first of all, you have to estimate the risk properly. And estimation risk is a very, very difficult thing. In fact, the efficient frontier, nobody tells you the dirty little secret in grad school. And certainly, I am reluctant to say that in my introductory PhD class. But the secret is that portfolio theory really doesn't work. It doesn't work in the sense that we don't actually know what the parameters are. And if you don't know what the parameters are, you can show with a very simple, 3-asset example that small perturbations in your estimates of expected return and correlation lead to huge swings in weights. And so that's one of the reasons why, portfolio theory in pure and simple form is not used in practice. What people use are variations of it where they impose constraints or they make simplifications. The basic idea is important, the framework is important, but the execution requires a lot of engineering that's not part of academic publications. So that may be what you're looking at, is you're not estimating the risk properly, or the risk is not stable and you're not lining it up properly. All of that matters a great deal. On top of that, this notion of freaking out is something that I am particularly focused on. When you've got very, very strong behavioral currents, when you've got panic, you're not going to get the traditional risk-reward relationship emerging. Yeah, question?
Yeah, I think a lot of your topics, the concepts you refer to, I think I'd broadly refer to that as systematic behavioral kinds of considerations.
Yes.
And I think, people can disagree or think about things leading up to the financial crisis, and I think most would agree that on a policy level or regulatory level, there was some level of complacency leading up to the crisis.
Yeah.
And I think a big reason for that is that, while people reluctantly accept behavioral finance or behavioral economics, that they're even more reluctant to do so on a systematic level. And I think in the period leading up to the crisis, that never even had a chance to have a seat at the table. Mm-hmm. And probably still does not, because there really is no mechanism for it. We sort of still live in a efficient markets world at a policy level. Do you agree with that? And do you see any path forward that changes that really becomes part of the lexicon in thinking at broad, systematic, the environment and what's happening?
Well, so first of all, I should defer to my colleague, Debbie Lucas, who is a policy expert and who's actually formulated policy and been part of government, as well as being a first-rate finance scholar. But rather than put the onus on her, she's going to be talking about policy issues later on this afternoon. Let me give you my take on it, which is that I think that there is change going on. One example of change is that Cass Sunstein, who is a very staunch proponent of behavioral ideas, is now, has a job in the government, and I think has been trying to formulate behavioral aspects of policymaking. But I think that you hit upon a good point, which is that most regulation does not take into account the frailties of human behavior. And I think complacency is something that afflicts all of us, policymakers, market participants alike. One good example is the credit default swaps market. People often point out the fact that Brooks Lee Bourne, who was head of the CFTC in the late 90s, she held out the red flag saying we got to worry about credit default swaps. And in 1999, 98, 99, she held a number of meetings at the CFTC about reining in the credit default swaps market, and she was unilaterally overruled by the triumvirate of Alan Greenspan, Bob Rubin, and Larry Summers. They were in a room together with her and basically told her shut up. And I don't know about you, but if I were in a room with the three of them and they told me to shut up, I would shut up. However, in fairness to the three of them, in 1999, the credit default swaps market had a notional size of something like, I don't know what it was, maybe 50 billion, 100 billion, which sounds like a big number. But 7 years later, that market was 65 trillion. And so in 1999, Brooks Lee Bourne was early. She may have been right eventually, but in 1999, the credit default swaps market wasn't a problem. It's just that because it wasn't a problem then doesn't mean you could take your eyes off the ball and forget about it 7 years later when it became a really huge problem. And so timing is actually critical, getting the right timing. She was too early, and of course, the rest of us was too late. You have to get it just right, and we can't always get it just right. Someone once said that the difference between garbage and a salad is timing. And, how can you, we don't get it right. But then we want to develop regulation and policy that doesn't require us to get it right. And that's the challenge. We got to get smarter about policy. I don't think we need more regulation or less regulation. I don't even know how to weigh the quantity of regulation. Do you put the laws on a scale or the number of pages of the law? But I think what we need is better regulation, smarter regulation, regulation that takes into account the adaptive nature of human behavior. And maybe Debbie will talk about that, or maybe not. We'll leave it to her. Yes, I think one more question since we're out of time. Oh, yeah, back there.
Andrew, I have a anecdote for you to add to the slide on alpha turns to beta the next time you give this to an MIT audience. This goes back to 1998 when I was working for Putnam Investments and invited Alan Bufford, then treasurer and head of the pension and endowments, over to do a bit of a sales pitch. And we previewed a new innovative strategy that straddled the private equity and small cap markets. And at the end of lunch, he sat back and folded his hands and he said, "This really is brilliant, but I'll tell you why I'm not going to give you any money. As soon as you guys collect all you can from the institutional market, you'll figure out a way to turn it into a mutual fund."
Well, I think it's true that a lot of alpha can very quickly become beta, but the very quickly part, you got to keep in mind that there's a whole lot of money to be made along that way. And so, eventually, in the long run, we may all be dead, but let's make sure that the short run doesn't kill us first. All right?
And could we have a quick preview of your current research project in artificial stupidity?
Well, sure. Yeah, I think the best thing about that project is the title. The basic idea is that we often chastise investors about not being long-term enough, particularly financial advisors and portfolio managers. We accuse investors of being hot money and focusing too much on short-term pain versus long-term gain. And after a while of reading these diatribes, I got kind of annoyed because it seems like we're expecting investors to be these super rational, almost inhuman robots. When in fact, no retail investor, and most portfolio managers, they don't behave this way. And so it occurred to me that when we look at an index like the S&P 500 and say, gee, if you had only kept your money in that, look what you would have done. You would have been great. You could have just kept your money throughout the financial crisis, not worried about it, and it would have been fine. That's easy to say ex post. But do you really expect investors to see half of their retirement assets evaporate before they decide that, gee, maybe it's time to do something? That's just not realistic. It's sort of like telling teenagers to abstain. I mean, you can tell them that, and maybe they'll really try hard to abstain. But when they go off to college, you don't know what they're going to do, and so maybe you ought to try something else, like acknowledging that human behavior is real, and then trying to simulate that behavior to see what they are likely to get, and then look at ways of dealing with those. So for example, instead of looking at the S&P 500 as a benchmark, what if we were to simulate human behavior and say, after a certain period of time and a certain loss, you will take your money out. And then after you wait a period of time, you will put your money back in. Let's simulate real behavior and call it artificial stupidity, for lack of a better term. I want to simulate the kind of behavior that humans are likely to exhibit. It turns out that when you do that, you find out something really remarkable. What you find out is that people lose money in the long run, not because they pull money out when things are going bad. It's actually because they keep their money out too long and don't know when to put it back in. The pulling it out is not the problem. Actually, in most cases, when you use simple rules that say, after I lose 15 or 20%, I'm going to go half to cash, that's actually not a bad rule. The key is you got to get back in. And this was also made clear to me when, literally a month ago, a former college classmate of mine that I hadn't heard from in a decade, he called me up and said, I need some financial advice. During 2007 and 2008, I was watching the markets really carefully, and I actually went to cash, at the fourth quarter of 2008, and actually I think I did pretty well. So I said, well, what do you want from me? What kind of advice can I give you? He says, well, I just want to know, do you think that now is time to go back in? that's what artificial stupidity is about. It's to try to understand how people behave and then what the proper benchmarks are to capture that kind of behavior. Thank you very much. Appreciate it.